Have you ever felt that investing is like navigating a complex machine with many moving parts into the world of investment risks? To truly find the best investment avenues, it is essential to first understand the different types of risks that can affect your money. We will be looking at inflation, liquidity, credit, market prices, and interest rates. Let's start with the silent thief that affects everyone. Inflation or price inflation is simply the general rise in the prices of the things we buy every day, like food and services. It slowly eats away at the purchasing power of your money. Imagine you have 10,000 rupees today. If inflation stays at 8% per year, in 5 years you would need 14,693 rupees to buy those same goods. After 10 years, that cost jumps to 21,589 rupees. If we look even further, after 20 years you need 46,610 rupees, and after 30 years you would need a massive 1,627 rupees. Essentially, if you could buy 100 units today, you could only buy 68 units in 5 years and just 46 units in 10 years. This shows why we must account for this risk over long periods. Building on that idea, we need to distinguish between what you see and what you actually get. To protect your purchasing power, your investment return must be at least equal to inflation. This brings us to the difference between nominal and real rates of return. The nominal rate is your return before adjusting for price rises. For example, if your fixed deposit gives you 7% per year, while inflation is at 8% per year, you are actually facing a negative real rate of return. Even though your capital feels safe and you have anytime liquidity, your purchasing power is dropping. A positive real rate only happens when your returns are higher than inflation. Now that we understand inflation, let's talk about how quickly you can get your cash back, which is known as liquidity risk. Not all investments are the same. We have high or instant liquidity, like equity shares listed on stock exchanges, which you can sell very quickly. Then there is conditional liquidity, often found in fixed income assets or government securities, where you usually need to wait until a certain date. Finally, we have low or delayed liquidity, which is very common in real estate. Selling a house can often take weeks or even months, making it hard to access your money in a hurry. To see how this works in practice, let's look at a common example involving a bank deposit. Imagine you choose a 5-year fixed deposit for a goal 5 years away. The bank promises to pay you a certain return, but only if you keep the money there for the entire time. If you need that money earlier, there will likely be a deduction or penalty in the interest you earn, which reduces your overall return. Other products like the PPF have even stricter rules, where you might have no liquidity for years and only partial access after that. Moving on from how fast you can get your money, let's discuss the risk of actually getting it back at all. This is called credit risk. Think of it like a loan agreement, where the issuer of a bond or debenture is the borrower and you, the investor, are the lender. There are 3 paths here. The borrower might pay everything on time, they might pay but with a delay, or they might not pay the principal or interest at all. This last case is what we call a default. This risk is usually driven by 2 things: whether the borrower has the ability to pay and whether they have the intention to pay. Because of this risk, there is always a balance between safety and yield. A lender will always check a borrower's stability before handing over money. Generally, bonds issued by the government of our own country are considered the safest for citizens because they have the highest safety. They offer the lowest interest rates On the other hand, corporate bonds and debentures sit at the upper level of the risk pyramid because they have lower safety. They must offer a higher rate of interest to compensate you for taking that extra risk. Now, let's step into the open market where opinions rule. Market risk and price risk happen because people buy and sell based on their fast changing views, which causes volatility. We can look at this through a risk radius matrix. At the very center is company specific risk, like when a specific firm's sales fall and its share price drops. Moving outward, we have industry specific risk, such as when a new technology like mobile phones makes the pager industry disappear. At the outer edge is market wide risk, like a war like situation that causes fear and makes almost all stock prices in the entire economy fall at once. So, how do we protect ourselves from these fluctuations? Think of diversification as a shield. By spreading your money across many different and unrelated securities, you can significantly reduce those company specific risks. However, it is important to remember that market wide risks cannot be reduced through diversification. No matter how many different stocks you own, a general economic crash will still impact the whole market. Next, we must consider a specific factor that hits bonds and debt instruments very hard: interest rate risk. That your investments as value will change because of a shift in the general interest rates of the economy. The most important thing to remember here is that the relationship between interest rates and bond prices is inverse. For example, if you have a bond issued at 1000 rupees with an 8% interest rate and new bonds suddenly start offering 8.5%, your old bond becomes less attractive. If you want to sell it, you would have to do so at a discount. Building on that, the impact of this risk depends on your plan. If you hold a bond until it matures, you will receive the full amount promised in the agreement. However, if you decide to sell in the secondary market, you must accept the current market price. It is also vital to know that bonds with longer maturities face much higher price fluctuations when interest rates change compared to those with shorter maturities. This is a market-wide factor that touches every bond out there. Now that we have identified these risks, how do we handle them? In this video, we will explore three main strategies: avoiding the risk, taking a strategic position, or diversifying. But before we can manage risks, we must measure them. Experts use different tools for this, like credit ratings, to check for credit risk, or variance and standard deviation to measure volatility. We also use things like beta to look at price fluctuations and modified duration for interest rate risk. Let's look at the first strategy, which is to simply avoid certain risks. With a particular risk, you can choose to bypass those investment products entirely. However, there is a clear trade-off. By avoiding the risk, you also give up the opportunity to earn the potential profits from that investment. A key expert recommendation is to always avoid any investment avenue that you do not fully understand. The second strategy involves taking a specific position to benefit from expected market developments. For instance, if you expect interest rates to go down, you might choose to sell bonds with short maturities and buy bonds with long maturities instead. If your judgment is correct, you could be rewarded handsomely. However, if your judgment is wrong, you could face significant losses. This approach requires superior knowledge and high skill, so it is generally not recommended for most regular investors. Finally, for most of us, the most prudent approach is to diversify. Since not everyone has the expert knowledge needed to time the market, we spread our risk across various options like equity, fixed income, real estate, and gold. This creates a system where even if one area, like equity, faces a loss or a breakdown, your other investments can keep you moving. By diversifying, you significantly reduce the probability of losing everything and ensure a smoother journey toward your financial goals